So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani. Really awesome episode today. I'm joined by the amazing Melanie McDaniel. Melanie is the founder of Freestyle Capital Group, a boutique private equity firm, and Freestyle Fund, a customizable fund. She partners with passive investors to invest in private equity real estate transaction across a variety of asset classes, operators, geographies, and investment strategies. Melanie offers a Michelin Star experience with curated investment opportunities and aims to have a personal relationship with each investor. Melanie, it's great to have you on today. I'm very excited to talk today. A lot of fun stuff to get to. Let's kind of just start at the beginning, though, kind of talk about your story starting out and what led you to where you're at.
All right. Well, thanks for having me, first of all. My story is a lot like a lot of people, kind of middle America, grew up, great family, great suburbia life, taught, go to school, get good grades, go to college, get a job, a career. And then, of course, my dad would add in one with a pension because he worked for the state from Utah originally. So that's the path I started on. School came pretty easy. I got good grades. And when it came time to go to college, I didn't know what I wanted to be when I grew up. And I was smart enough to know that it would be a waste of time if I just went to pay for college and I had no idea what I wanted to study. So I love to travel. And I decided, well, maybe if I join the military, I can get some experience in. Then I'll make money for school, right? Or make money, but also get the GI Bill and all the benefits of that. Travel, figure things out, get kind of on my own 2 feet. So that's the route I went, which was a great route because I was in the Navy and my first duty station was in Italy. So check that box.
Nice.
I did my 4 years and just started feeling like it wasn't my calling. I wanted to go to school. I kind of felt like I was stagnant. So I got out. I went, when I was figuring out what I want to be when I grew up. I still didn't know, by the way. So I'm like, well, I need to study something. I can't just keep putting that off. So I thought, well, what do I love to do? And I'll study that. So it was to travel. So I studied travel. I have a bachelor's degree in travel administration.
Oh, wow.
Yeah, I know, right? From Denver, I went to Metropolitan State University. So then I got my bachelor's degree. I moved to Hawaii. I had lived there a number of times. I've moved and traveled quite a bit in my life, but I moved to Waikiki and worked on Atlanta submarines. And I was a deckhand co-pilot. I lasted about 4 months and realized cleaning up people's vomit and doing that with no real career ahead of me was probably not the best use of my time. And then I still didn't know. I did not know what I wanted to be when I grew up. And the reason why I think is because I was taught to go to school, get a job, get a job. That's what I was taught. And it just did not resonate with me. I didn't have any entrepreneurs in my life to model after. I did not have any exposure to the financial industry or business. My parents were employees, and that is all I was exposed to. So I thought, well, I've done the military. My dad's wife is a park ranger, was at the time as well. And I'd seen her when I was going to college in Denver. She worked at Rocky Mountain National Park. So I spent a lot of time up there. And I thought, well, that seems interesting enough, right? So it's law enforcement, search and rescue, firefighting, and EMS. And so I went down that path, ended up in that for 9 years, right? I just wanted to do it to buy myself some time, but I ended up making a career of it. But in 2015, I read The Purple Book, Rich Dad, Poor Dad, which changed a lot of people's lives. And I read it in 2015 and it was just mind blown. The concept of money, making your money, and not having to trade your time for money. I realized as a park ranger, I put a bulletproof vest on in the morning to go to work, my shotgun, my rifle, I had a taser on me, a radio, and handcuffs. And I went to work and made like $60,000, okay? And that's a lot of money. I mean, not a lot of money to put your life on the line every day. And doing a job, it was good enough pay. It was good enough time off, good enough benefits, good enough job that it wasn't painful enough for me to really know how unfulfilled I was until I read that book, saw the light, started studying how to, one, be an entrepreneur, but also have passive income so I don't have to actually work. So that's the path I started. 2015 is when I read the book. 2017 is when I literally left the federal job, left it all behind, had only debt, and moved from California to Virginia because at the time I was dating a Navy guy and he got orders. And I'm like, oh, clean slate, just go jump and do that. I became a real estate agent as a stepping stone. And so that kind of got my feet wet with the real estate and getting some experience. And along that journey, just kept learning for, years of learning, listening to podcasts, reading books, and finally realized I like economies of scale, and multifamily made the most sense. It's foundational and fundamental to human existence, right? We all need a roof over our head. I don't think that's going to go out of style. So that's the route I went.
Hope not.
So I started Rich Dad Poor Dad training program. That was expensive. I did Michael Blanc's apartment buying program, ended up buying my first apartment complex, but then decided I didn't like the acquisitions, didn't like talking to brokers. I was kind of to this point where I didn't love it. I love what it is. I believe in real estate. But what I do love is talking to people. I do love finding deals, negotiating. And I thought, well, if I'm in the middle of that, find the people that want to invest, find the people with the deals. And if I can step in the middle and make a beautiful, marriage, then that is the career I wanted. So I launched in 2020 from Thailand because at the time I quit being a real estate agent because that was just the stepping stone, right? And I launched fully to being like a capital partner and doing co-GPs. So I was in Thailand because I was fully nomadic, sold everything, and I was going to live abroad for the year. And then I came home to go to the Best Ever Conference in 2020, went to that in Keystone. In March, I was supposed to go to Playa del Carmen, but we all know what happened in 2020, March 2020. Wow. So that kind of stopped me in my tracks of the international travel for a bit. So yeah, that's kind of my journey. Was looking for co-GP, ended up doing a SPV fund, and now I'm full-blown fund.
Awesome. So all through there, was there any, did you dip your toes in the residential game at all, have a residential portfolio, or did you kind of just go from agent to realizing you wanted to do kind of the commercial syndication space?
Yeah, I definitely dipped my toe in the residential space because I had a self-directed, let's see, was that my IRA? Yeah, I think my self-directed IRA. So I bought this little POS house in St. Louis, Missouri. It had a tenant in place. I think I paid $48,000 for the house and the tenant was paying $800 or something, right? So that's great. And for a retirement account, especially IRAs, if you don't have any debt on the property, then you're not subject to that UBIT or UDFI tax. So I thought, well, I'll just buy that. It's easy cash flow. It's, return on investment is pretty high. But my tenant paid rent for about 8 months and then stopped. And it took about 5 months for me to evict and get the property back. $10,000 or so later, rehabbed and ready to rent the next person. So my property manager got a tenant in there and I sold it. I sold it at a loss, overall loss. The price I got was, a little bit more than I paid, but the loss of rent and the 10K I had to put in to get it back online. So that was my experience. And I never want to have something like that again.
Absolutely. Totally understand. And that's really where I think everyone kind of at least starts in some way or another before they realize, like you mentioned before, economies of scale and how much you can really scale in commercial because, you're talking about one unit, no one's in there, then there's no rent. But if you have 100 units, even down 10%, obviously still cash flowing, different things like that. So you realize you didn't love the syndicate or the sponsor and sort of the operator space. So kind of talk about, discovering the fund model and kind of the capital raising side of things. And, you launched it remotely. So I guess talk about, investor relations and those kind of things remotely.
Sure. I'm going to touch just on one thought for the why not single family.
Yeah.
And then I'll move on to that because I think a lot of people don't think about this, but it was a reason that I jumped pretty quick into multifamily. Any idiot like myself can buy a single family, right? It's easy. 50 grand, 100 grand, easy, get her done. But to take down a $50 million apartment, you have to have experience, track record, you have to have a relationship with a bank, you have to know what you're doing. So I feel like if a passive investor wants to invest, level up a bit to a certain tier of experience needed, right? And professionalism, we'll call it. So that was one of my other reasonings. I thought, well, if I'm not the professional and I'm raising capital or bringing investors in, then I need to partner with people who are the professionals. Let me be the dumbest person on the team, right? So that was kind of how I started back in 2020. I'm not the dumbest person on the team anymore, but at the time I was just getting started. So my idea was I wanted to work from a computer anywhere in the world that had Wi-Fi. I could conduct my calls on Zoom. P.S. I was a Zoomer at least a year before everyone else was because of COVID.
Look at that. Pioneering.
Yeah. I used it to talk to clients that were moving to the area because it was a military town. So I targeted a lot of military people moving to Virginia. So they weren't there yet. So we'd have these Zoom calls and then I would go tour properties and do videos and stuff. Anyway, so I knew I wanted to work from a computer because I wanted to be location independent. The capital piece, talking to investors, very doable. We don't need to have coffee or have lunch, although I would love to do that with all of my investors, but it's not needed. The sponsors, I was already starting to build relationships with a number of sponsors. So I thought, well, surely the X, Y, and Z, those guys will call me, right? When they need capital, that's what I thought. So I'm like, I'm going to raise capital for X, Y, and Z, and I just need to bring in the investors and we're going to co-GP and it's going to be beautiful. Well, okay, COVID happened. I lost 6 months. But then in July, when my XYZ favorite operator started doing deals and they didn't call me, I'm like, whoop, bop, beep, hello? I see you're doing a deal and you haven't called me. Like, can I, participate? They're like, well, how much money can you raise? I'm like, I don't know. I'm new, And they're like, we're not giving you GP to raise something you don't know. So after July, I saw 2 of those operators each buy 2 properties and not call me. And I'm like, oh crap. I just put all of my eggs in a basket that's not even mine. So that's when, luckily, everything worked out with COVID and everyone going virtual. I could go to a bazillion meetups, conferences, masterminds, whatever, nationwide. So COVID was almost a blessing for me because I really in 2020 got to attend a lot of events that helped me meet a lot of people. Now my list of operators is not 3 dudes because they were all dudes. It's like 100 operators and I cross them off the list as fast as they jump on the list because when I do vetting and due diligence, there's just not everybody checks my boxes. So that's been the journey. So going from what I thought I was going to be a co-GP and raise capital on a GP became, okay, I don't know how much I can raise. Nobody wants to take a chance on me on their GP and I get why. So what do I do instead? Well, BEC Virtual 2021, Hunter Thompson did a talk about SPVs.
Shout out.
Yeah. So he was the first seed in my mind of an alternative to a co-GP. So it took me another 6 months after that. And we're talking a year and a half after I launched my business. Okay. January 2020 is when I launched, or February. It wasn't until July of 2021 that I did my first deal.
Oh, wow.
And it wasn't because I didn't have opportunities. I had all winter long, spring, I had opportunities, but nothing was good enough for me and for my investors and for what my investment strategy was. So by July, I had a deal. I formed an SPV because it's when I go to an operator and say, hey, I want to co-GP with you, not sure how much I can raise, probably $500,000. They're like, but if I say, hey, I'm going to bring you $1 million check as an LP, then all of a sudden they're excited.
Correct.
One LP, $1 million. But to get that $1 million, I had partners. We formed the SPV in a single purpose vehicle or single purpose entity or fund of funds or fund to funds. This is all verbiage kind of for the same vehicle.
Yep.
We became the fund managers, 3 or 4 of us, and we each brought in capital from our friends and family. And that investment vehicle invested as an LP in the deal. So that's how we got our first deal done. And then sorry, go ahead.
No, I was just going to say, so that's awesome. So over this course of this time, you're really just putting your face in as many virtual events as you possibly can. Obviously the whole world is virtual. So it makes it easier for the rest of the people to be like, okay, this is a great way for me to meet. I know you're a huge proponent of, sort of that boutique experience, getting to know all of your investors. So through all of this, are you still, getting on Zoom calls with them as much as you can, or is your list growing to the point where, you're kind of just keeping them, on your list, but not necessarily talking to all of them?
I know all of my investors. There are people in my CRM, I guess, that I don't know potentially, but my actual investors, by the time they invest, I know them, or only the people I know really invest, right? So, because people can come and download your free lead magnet or get in your funnel real easy, but if you don't have that personal relationship, either you need to reach out to them or they really want to talk to you, whatever. It just kind of, they just go to your CRM to die, right? I mean, unless you're really good at it. I want personal relationships. So if I don't have a connection with somebody and they don't try, I'm really not, I don't know. I don't dig and find people. I probably should, right? But I have enough people that I know well enough that when I do deals, I can raise the capital. I'm not saying I can raise 10 million bucks or something. I'm just saying right now how I've done it is very boutique. I know them. So I'll send
Right.
out the newsletter, I'll send out the offering, but I'll follow up with direct phone calls for the people who I know have been chomping at the bit for a deal. My first round of investors, a lot of people ask me this, especially if they're new in the space, like where do they come from? How'd you meet them? Well, as a real estate agent, I had a meetup. I serviced really only investors. I had 500 or 600 people on my list just from being a real estate agent, providing training on how to invest in real estate. That most of my first round of investors came from there. And then my
Oh, wow.
CPA's boss somehow ended up in there. He's the only one I've never seen his face. I've never even talked on the phone with the guy. He's so funny. He's invested in 2 of my deals. I've talked to his assistant, but I've never seen his face or heard his voice. But we've exchanged lots of emails, and then I've talked to his assistant. It's kind of funny. And he's a CPA. I mean, I don't know, which makes me feel good. Like he surely knows how to look at a deal. Whatever. I'm glad he trusts me. That's very nice of him. Otherwise, I know everybody. And since then, I've gone to a ton of conferences and met a lot of people. So I would say all those people that are now in there, I still know everybody.
And now you're probably putting a lot of faces to names because, again, you're kind of really coming up in the Zoom era, I think is what it's probably going to be dubbed here. History will look back and call
Instead of
it the Zoom
boomers, we're
era.
going to be Zoomers.
Yeah, exactly. When kids are studying this era, business students are studying this era, it's going to be the Zoom era. So you kind of came up through that, obviously putting a lot of faces to names now that we're back to in-person conferences. I know BEC was like that for me. I met a lot of people finally face to face. So going back to your first deal then, it sounds like it kind of has snowballed from there. So kind of talk about now your process. You said you have a, kind of a big list of sponsors. So kind of talk a little bit about your first deal and then, kind of the thesis you use as you move forward and vet deals and sponsors.
Well, when I did my first deal, I was still in the school of thought that I needed to be really good at one asset class, right? And that asset class was value add multifamily. And I kind of stuck to that for a while, but then I realized there are other really great asset classes out there, first of all. But second of all, how our economy is going. And during COVID, things started changing. Now with the war, it's even more amplified. I think it's kind of the old school thinking, the whole Warren Buffett quote, and I'm going to misquote it. Basically, he's like, diversification is for someone who doesn't know what they're doing, right? So diversify if you don't know. If you know how to underwrite a business, and syndicators were infamous for this, I would say a couple years ago. It's like, well, why would I put my money anywhere else? If I'm really good at buying apartments and getting a great return, why would I go invest in Bitcoin or other investment, whatever, right? So, but now there's so many unknowns with inflation, with interest rates, the economy. Look what happened to multifamily during COVID. It survived. It did well for the most part, but not everything did well. Some Class Cs and things did not do well. By the way, my first 24 unit is a Class C, and we still have not taken a distribution, and we bought it in January of 2020. We're still just floating, and our lender, because we closed, never stabilized, COVID hits, and it's just been a rough ride ever since. We had to use 3 or 4 months of the not pay your mortgage thing, whatever that's called. But we might get profitable soon. But Virginia, the, let's say, political state of the state that it is not landlord friendly.
Right.
And
Oh,
I
wow.
will never buy another apartment complex in a state like that because they have handcuffed us, won't let us evict our tenants, but also have tens of thousands of dollars of backlog money that they owe us, but nothing. It's been months. So
Wow.
anyway, we're in the black, but we're not like dancing, to the bank. We will survive because of compressed cap rates and we'll win overall. But if the economy wasn't as awesome as it is and rents raising, that would have been a failure. So anyway, what was I saying?
Absolutely. A lot of lessons
asset
to be
classes.
learned there for sure.
Yeah. So I'm all about diversification now, and I'm really loving industrial, triple net specifically, absolute triple net, really, because industrial has, so between multifamily and industrial, if you remember at Best Ever when they did the economic update, multifamily was at 2.5% vacancy, industrial is at 3.9% vacancy. So arguably the best. I mean, everything else, retail, office, like all the other asset classes, 6% or 10 or 12,
Right.
even storage and mobile home parks. So the best, fundamentally, I think multifamily always, but we have to deal with tenant laws. And then industrial, I'm really loving triple net and industrial because you have one tenant, and if you underwrite that tenant and they have a strong business, that they did so well during COVID. Industrial didn't even skip a beat. It actually got better. Cap rates
Right.
compressed a bit. And the vacancy is so low that tenants aren't leaving. You can raise their rent. They're not going anywhere. I had a guy tell me he had a TJ Maxx. I don't remember what market it was. And he raised their rent 40%. And they're like, well,
Jeez.
we're going to go shop. We're going to move. And they go shopping around and they came back and paid that 40% increase. Why? Because there is nowhere for them to go.
Wow. Okay. So that's kind of a newer, well, it's not a newer asset class, but it's starting to become more popular for the reason which you kind of pointed out, one tenant, the triple net aspect. So kind of explain the nuances to that, what that deal structure looks like, and kind of the terms of the triple net.
Yeah, so there's, and I'm by no means a pro in this. I'll just give you kind of the overview. The triple net is the net, and then absolute triple net. So, and to break them apart, I might not say this correctly, but I'll just give you like my idea of it. So just a net lease would mean the tenant pays their rent and maybe their electric bill, right? A net might mean that they pay their lease, the electric bill, and they pay for some maintenance or something. And a triple net means they pay all the taxes, insurance, maintenance, they pay the rent, of course. And then an absolute triple net means they pay for the building, the roof, the landscaping, the wall falls off the side of the building, they pay for that. That's absolute triple net. So there's really no expenses, no costs, no insurance, no taxes, nothing. when you buy an industrial building and your tenant is Amazon, they just pay you rent and you sit back. The difference is, the rent per square foot's a little less with an absolute triple net, where you could get a lot more per square foot if you're taking care of the building. But man, I'd rather take less rent and do nothing, have none of the risk. The risk is only if the tenant leaves. But in today's market, with the vacancy rate being so low, you have no problems finding a tenant. You almost wish they'd leave because they lock in 2% escalators. And we know the market is moving not at 2%, it's moving at 5, 7, 8, 10 because of inflation plus demand, right? So it's like, please break your lease, please leave, because the next guy after you, I can
And these
charge
are
him
typically
10.
long-term lease contracts, correct?
So there's a couple of kinds. They're short term, 3 and 5 years. Arguably, I like those better, though I have raised for what's called a seller lease back, and they're locking those guys into 15, 20, 25-year contracts. But I'm thinking, if you lock them in for 20 years, 2% rent escalator, but rent is actually going up 5% every year. So you want to sell that thing in 5 years, right? Who is the buyer when it's not at market rent? Debt prices have increased, interest rates have gone up. Like, who's going to buy that? You'll actually lose money, or you have to sell it for less than you bought it for to accommodate that. So I don't like the long-term locked in rents right now. I think for a long time that was a strategy people did, but I can't wrap my mind around it. When I've asked a number of these seller leaseback guys this thought I'm having, because I don't know what I'm talking about, right? It just conceptually, they say, well, there's all these institutions, they're only looking for a 2 cap and they're getting this at a 6 cap. And I guess if they're paying cash and they don't have to get debt, that could be arguably fine, but that limits your buyer pool.
Absolutely. So kind of talk about then, you obviously started with multifamily, your investors obviously, loved you there. Was it a pretty easy transition to introduce them to this industrial thing? Were they on board with the diversification, or, did that take some time to kind of get them comfortable with that other asset class?
The people who invested, I've only done one triple net. So, well, I've kind of done two. One was assisted living. So it felt like assisted living, but it was structured as a triple net. So we'll talk about that one later. But the
Right.
triple net, the people who invested in it know about it. There are a lot of people that are like, I don't understand industrial. I'm not doing that. I like multifamily. There are lots of those, actually more of those, I'm sure. So to answer your question,
Absolutely.
no. The best I can do is educate people on diversification. And diversification of investment strategy. So triple net, there's no value add component. You don't go in and make the building prettier to force rents. That is not the business model. The business model
Right.
is buy the thing, collect your rent, sell the thing when the interest rates, or not interest, when cap rates compress, or when you've collected your rent and you go. So the IRR isn't always as high, but your cash flow, paid monthly often, at least quarterly, if not monthly, 10%, maybe 8%, depending on if you're in a tertiary or secondary or primary market. So you're investing in triple net for cash flow, boring stableness. It's very boring. It's so stable and boring, but cash flow. You invest in a value add multifamily, you get a little bit of cash flow. Year one, hardly anything. Year two, maybe 3%. Year four, maybe 5%. Maybe by year five, or when there's a refi, you might bump it. And then you expect to sell it at a much higher rate. And that's where the IRR kicks in, right? Or your equity multiple. It's risky because you're force appreciating it over time. Rent rates are increasing. Debt's now like up and down. I'm not saying, I still love value add multifamily. Don't get me wrong. I still do. I'm just saying people should diversify their portfolio. Have some value add multifamily. Have some class A boring multifamily. Even if it's only a 6% return, it's stable. Have some triple net, have some assisted living, have storage, have mobile home parks, have a diversified portfolio and across geographies. So invest in lots of states. So if your whole portfolio is in Florida and it gets wiped out by one hurricane, your whole portfolio is gone. You invest with one sponsor. That sponsor turns out to be Bernie Madoff, and you lose your whole portfolio. You invest in one asset class, and all of a sudden nobody needs a roof over their head anymore. We're flying around in movable, jet pods. I don't know. I'm just saying, like, the whole asset class get wiped out. And then investment strategy, you're in value add multifamily only, or value add anything, and labor costs, supply chain, just whatever, it can throw your whole portfolio off. So I'm not saying anything is better than another thing. I'm saying diversification is better than anything.
Absolutely. No, I mean, you honestly nailed that one head on, right? And that's what I try to tell people, is everyone's so gung ho, and certainly, things are shaping up. We're not sure what's going to happen, which is exactly why diversification is so important, because there are so many variables. Of course, the ones we, can't foresee, like weather, but the ones we know are coming, like a recession, right? We don't know what's going to get hit. Is there an asset price bubble, and all these different things. So then this diversification really lets you sort of, kind of ease that stress of what might happen, because, you're hedged against all these different, things that can go wrong, I guess. So obviously, one thing with the fund of funds model, which I'm such a huge proponent of, is that allows you to diversify and take your investors to different geographies and asset classes. So as you're doing that, what kind of economic indicators do you look for to potentially get into a market or an asset class or different things like that?
So when I look at deals, the jockey is the first thing. Who's the operator? What's their experience? What's their track record? What do they have to say about their asset class or their market? I listen to them first. They're the expert, right? I'm diversified all over in everything and whatever. They are experts on one thing, one asset class, maybe one location. So I listen to them first. And if you get the jockey right, typically everything else goes right. But you're right, everything else matters too. Trust but verify. So there's 4 things I look at. You mentioned one, the market. If you're investing in housing, right, a multifamily, it matters what's happening in that economy. Are people moving there? Are there jobs? Is the population growing? And not just the population, is household formation growing? What's the supply and demand? Is there a bunch of stuff being built? Is there a need for housing? Can people afford the current prices? Is there room for prices to increase? Like the whole market outlook for the most part. And then of course, personally, I go for landlord friendly states. So typically my version of where I like to see is the smile states, right? The warm and smiley states so North Carolina kind of smiling up to maybe even up to Idaho or something, though I don't focus too much on Idaho and Utah, but Arizona for sure, Texas for sure. Great things going on in Florida, though I'm always cautious of, weather stuff. I love North Carolina, and then anything in between. Atlanta's doing great. Alabama, I've got a great property there. I think South Carolina's fine. I'd be open to hearing about Arkansas or some of, I don't know much about Mississippi, Louisiana, whatever, probably not those, but I'm open to anything that makes sense, but mostly those states. What were some of the other, what was
just your vetting process. So
Oh.
you start with the sponsor, and then
Yep.
sounds like you focus next on market, and then
Underwriting. The underwriting's
asset
next.
class.
Well, asset class, well, I'll say underwriting first. So whatever the asset
Okay.
class is, the underwriting matters to me. Conservatively underwritten, and the debt. Right now, whatever the debt is, sometimes the debt is the asset. Think about locking in a long-term loan at low interest rates, right? We're already kind of ticking up. So this may not even be available. I've had lenders tell me they won't even do long-term financing because they expect interest rates to go up. Everything's a 5-arm or a bridge loan or whatever. Be very cautious what the debt is. And if the debt is short-term, what's the exit strategy? How many exit strategies? Is it build to sell, build to rent? Is it buy, hold? Is it refi? Is it refi and hold? Like how many exit strategies? Is it a multifamily property they can turn into an assisted living? I mean, whatever it is, they can get creative, but I want to see multiple exit strategies. I want to see sensitivities. So if they're expecting a cap rate to be X, if they're off by more or less, what does that look like? Where's my break-even point? My cap rate? What's my break-even point? My vacancy? There's so much to look at in the underwriting. The assumptions. I like to see very boring rent increases. I want to see some rent or expense increases, especially with inflation and costs and supplies going up. I see these guys using just the old model 3 and 2. I'm like 3 and 4, 3% rent increase, 4. I mean, I don't know. It depends on the asset class and the market and all of that stuff. I am not an expert underwriter. I have no business underwriting it beyond just an overview. I have a institutional grade partner that does all the vetting of the underwriting. And I'm just lucky enough to have him. He worked for a decabillion-dollar fund until that fund went public. Now he works for the founders company of that fund. There's only a handful of guys that were pulled into that one, and he works there. But he's been my friend since 8th grade, so he's in my fund. But he's still a full-time W-2 employee with this other large fund in Salt Lake City. So that I just lucked out there. But so the underwriting I hire out, and then I look at how the deal's structured. What are the fees? How are the GPs getting paid? Is there an alignment with my investors? I am always investor first. My whole purpose in life is to help my investors make money. Then I might look at myself, and then I'll look at the sponsor, right? But I want everybody to be happy. But I want to see when the sponsor's getting paid. Oftentimes I get paid when the sponsor gets paid. So if my investors are taken care of and the sponsor's making money, then I don't have any issues. I'll make money. But do they have an asset management fee? Yes, probably. Do they have an acquisition fee? Yes, probably. And I'm looking for reasonable numbers. What's reasonable? Is it a $100 million property and they're taking a 3% acquisition fee? No, they should probably be taking a 1% acquisition fee. It depends, price, everything. Is there a refi fee? And is there a disposition fee? And if there is a disposition fee, do they get to have it regardless of how the deal performs? Like if my investors are losing money, you sell this thing at a loss, are you still getting your disposition fee? Because that's not in alignment with my investors. I've seen people throw in tens of thousands of dollars just in travel fees and thinking, well, I kind of think that should be handled in your company's management, plan accordingly. Different hurdles just different splits, return on capital versus return of capital. Do they have a refi fee underwritten in there? Because I don't even want to see a refi fee. Let's let that be the cherry on top. Let's not assume we need that because that juices returns, right? Does it make sense if you hold it for 5 years? Does it make sense if can you hold it longer than that, depending, on what's happening in the world? It's really a totality of what I see when it comes to the underwriting and the fee structure. Then when I'm looking at asset classes, the risk, like the risk level, what, is the risk
Right.
mitigated? And you can mostly mitigate risk with track record, experience, and of course, conservative underwriting for the most part. But yeah, doing background checks on the sponsors that can turn up stuff sometimes. Yeah.
So the biggest thing when people invest with you, which is what I tell people, when you're going the fund route, and even if you're just being a passive investor, but the reason that I'm a proponent of the fund route is, as you can see, her process is very in depth. By the time that she is sending her investors a deal, you're sending your investors a deal, you've done a full scale vetting process on the sponsor, the market, the asset class in that market. And so by the time it's, in front of them in an email or however it's in front of them, you've done this big in-depth process, which then makes them feel comfortable that, okay, I know that I trust Melanie and we can move forward with this deal because you've done this big, long vetting process and sort of eliminated that risk, which then allows them to still have their W-2 job in their busy lives.
Yeah. I mean, of course, people are always, they need to be responsible for their own investment choices, right? It's really on them. It's their money. They should have some sort of due diligence vetting process on their own. But yeah, a lot of times I don't think what my investors actually know what I go through for them.
Yeah.
And people know me. I go to tons of conferences. People know me. I know a lot of people, and I know a lot of dirt on a lot of people. And I don't, just tell my investors. I just don't present them those deals. No,
Right.
I know. Call it gossip, whatever you want. I know a lot of things about very specific deals. I've had people many times bring me a deal. It's like last minute, they need money in 5 minutes. And I'm just like, oh yeah, I saw that deal about a month ago. Totally not interested. Like, I already know I don't, it's funny. It's a small world and you need to keep your nose clean. You screw up one time, it doesn't go away.
Yeah, and people don't forget those things, which is why it's so important to do all this due diligence. And like you said, even if you are just going to be a passive investor, invest with someone, like Melanie or myself, who is also doing their in-depth due diligence. It's also important to do your own.
Yes.
And I always want to make a point of that to people. It's important to know where your money's going, even if it is with someone who like and trust. So awesome. Well, we're getting towards the end here. I wish we could keep talking forever about it. But we'll jump into the final 5 questions, just the last 5 questions that I ask everybody. First question is the best advice you've gotten from a mentor.
Oh man, the best advice. I've gotten so much advice, and every time you get advice, like depending on where you are in your life, right, it means the most. The only thing that's coming to my mind right now is just authenticity. Just be yourself. Everyone else is taken. You've got to just be yourself. Be true to who you are. It's not really advice necessarily for a passive investor, right? It's more for people in the industry, and you're trying to raise money, or you're trying to do a deal, or you're trying to do business. You just be yourself. I don't have a problem doing that. So I don't know. Maybe that's my own advice, but
people are investing in
life,
you.
somebody
And
said that.
I mean, I've followed you for a long time on LinkedIn. I think that, you're very much staying true to yourself. And obviously, without kind of getting too far back into it, I assume that's kind of where the freestyle name came from, is just that freedom lifestyle that you enjoy and want your investors to enjoy as well.
Yeah.
What's that?
Financial freedom, lifestyle design. That's where the freestyle comes from. But yeah.
I love that. That's awesome. So what is it about your career that makes you feel like you're fulfilling your why?
I mean, doing what I do and helping people grow their wealth, because what our school system and probably our parents, not knowing any better, has taught us is to be stuck in the matrix. I want to help people get out of the matrix. I want to help them have their money, make their money.
Absolutely.
And I want to help them do it as risk-free as possible.
I love that so much.
I love what I do.
Awesome. That's so great. And that's so universal, I think, as I talk to people across this industry, is that, it's a lot of work, right? I mean, you see people on LinkedIn and there's closings left and right, but if you really know the ins and outs, there is so much work that goes into it, how much due diligence you're doing before a deal even goes in front of your investors. And so you have to love what you do. And, certainly we're afforded luxuries, but they, we have to work hard for them. So being able to help people do that and love what you do is so great. Okay. What is your favorite non-real estate or investment related book?
The Power of Now.
Oh, I love that book so much.
Between Rich Dad Poor Dad and The Power of Now, those two books really set me on a new path in life after reading those two. Huge pivot.
That's so awesome. Are you familiar with Marvel superheroes at all?
I mean, I've probably seen some of the movies, but definitely not followed them too closely.
Fair enough. So of the ones which would be your if your personal avatar was a Marvel superhero, which one would you be?
Deadpool, is he a Marvel superhero?
It's fine. We'll allow a crossover because I'm a huge Deadpool fan and I love that so much. So that's amazing.
I just love it because he doesn't take himself serious. The movie's funny and I say the F word a lot. So I really resonate with just being a freaking honey badger. Like he's a honey badger. So
oh, I love that. That's the best answer I think I might have gotten so far, but we may have to change it to just superhero so that people can choose, kind of the one-offs. Awesome. And then last one, what's the best way for people to get a hold of you?
I would say just going to the website, freestylecapitalgroup.com. They'll learn a lot about me. There's a free download there, or they could join the investor lounge. That will get them in the infamous funnel, right? Which gets them into some way of communicating with me and eventually being able to book on a calendar to talk to me about potentially investing. If they want to reach out for something other than investing, they can just email me and ask me their question. I get a lot of requests for people to have my time and pick my brain and whatever. I'm getting to the point I just can't do it one-on-one. It's eating into my time to build my business. So if they'll just email me, Melanie@freestylecapitalgroup.com, I'll respond the best I can.
Awesome. And we will link all of that in the show notes. Melanie, it has been so much fun talking to you. I wish we could continue, but thank you so much for coming on.
Yeah, happy to. Thank you so much for having me.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.